Why errors occur. So, in this chapter, the key points are errors can occur in both manual and digital accounting systems. In the exam, you're typically going to be asked to determine whether an error in the system will result in the trial balance no longer tallying. So what that is that the debits will no longer be equal to the credits. And it will be described as it will affect the trial balance, in which case the debits will no longer equal the credits, or will not affect the trial balance, in which case the debits will be equal to the credits. So that's what the examiner calls a trial balance no longer tallying. Classify the name of the error. So you'll be given an error and then you're going to name the error. And you've then got also as well, calculate the journal required to fix an error and clear a suspense account. So where we have a trial balance that doesn't balance, we're going to put a suspense account in. So this is an account which we put in that makes the trial balance now balance, so the debits equal to the credits. You then find the error, which will be given to you, and you'll clear that suspense account. Or alternatively, you might have a scenario, and you might be given an error, and then you're given a series of scenarios, and you're going to select which scenario created that error. And so all of these questions, really, apart from the name the error, are very much about double entry bookkeeping. So this is where it's probably the hardest questions in the exam, and the reason why students don't like, students who struggle or fail don't like this question mainly is because they don't have a good grasp of double entry bookkeeping. So it's possible to pass the introduction to bookkeeping unit without really actually being any good at double entry bookkeeping, because you just use dead click to pass the opening trial balance question and you filled in a few invoices and what have you, and you can still actually pass that unit without knowing double entry bookkeeping. The problem is that you get to this unit and you're not going to be taught double entry bookkeeping properly, and because you've got dead click, or you've got the balance method of assets minus liabilities equals capital, but you need to have it as being really good. Okay, so it needs to be really good. Now, which is why I teach the money in, money out method, and use that paper and cups exercise to really make your double entry bookkeeping really sharp. And because it's then really sharp, you can then come into this unit, which is what all of that is set up for, and then answer these error questions easily. Which means if you're struggling with it, what you do need to do then is to have that good grasp. And so that's chapters 1 to 6 really in the introduction to bookkeeping playlist, and the papers and cups exercise there. If you're finding this difficult, let's say you've tried this before with a different book and you've done an assessment and you've sort of failed on it there, and then you're failing in this section here, the errors questions and the T accounts ones, the control account ones, which are T account questions, that's to go back and do that book. You might want in those chapters there, and that will fix it all really. A lot less painful as well than using dead click. Dead click's a lot of memorizing things, whereas my approach is you understand 3 things and then you just apply them. It's much simpler and much easier. It's a proper way of learning it as well. So we've got our questions, and we've got lots of error questions in the exam. It's going to take up 30 to 40% of the marks, so we've got a lot going on. So what I'm going to do is I'm going to do this over 3 chapters. In this chapter, I'm going to do the error names and the impacts on the trial balance parts of the error questions. I'm going to do that in this chapter. In later chapters, I'm going to go do the scenarios ones and suspense accounts in the journal. So that's what I'm going to do, and then I'm actually going to do the journal as itself in terms of journals into the journals into the journal. I'll explain later on what the journal is. It's a daybook in there, and so really we've got another 3 chapters after this, which we're going to be going through a lot of errors in there, because it's a lot in the exam. But it actually is more fun. It's quite fun there as long as you've got a decent grounding of double entry bookkeeping before you start. If you haven't, it won't be nice. So if our trial balance, because I sort of said that there's 2 questions in here, which is one which is about balance sheets balancing, or 2 sets of errors. One's where balance sheets balance and one where balance sheets don't balance. But if the balance sheet balances, why are we concerned? We've got a trial balance that balances. What's the problem? Well, we've got a couple of things that could happen. So a small error in the trial balance, even if it's really small, so what does it matter? It's only a couple of pounds. Could be a large error one way, could be a large error the other. Or alternatively, the balance sheet might perfectly balance, but we've still got a really large error one way and a perfectly offsetting error the other way. So there's a compensating error. So we could have a big error in there that could actually mean that our accounts are distorted. our posting could actually materially change the assets equals liabilities plus capital figures. So we might post motor expenses, a capital account, a debit capital, to motor vehicles at cost, an asset account there. And our figures then would have a much higher asset figure, and therefore a much higher capital figure as well. And actually this asset doesn't exist, so the shareholders don't own it. So it could materially change the accounting equation. That's called an error of principle. It could have missed items, so we could have missed out an invoice in the sales ledger, the sales daybook. So it's not in the sales ledger control account, and it's not in the sales ledger, and it's not in sales, and it's not in VAT. So it could omit items, and we could have what's known as an error of commission, where we posted something to the wrong account. So we posted it to A Jones rather than B Jones. It's not an error of principle. It's an error of commission, but we're chasing now the wrong customer for an amount paid, and the other customer we're not chasing. So even if our balance sheet balances, we still got these errors, which actually are quite important. Well, very important. So I'm just going to give a summary really of errors that we have. And first of all, we're going to focus on this side, because in terms of the naming of errors, you're going to tend to be asked to name errors that do not affect the trial balance. This side here of errors that do affect the trial balance will tend to be given you in journals, and you'll be sort of calculating suspense accounts. And the examiner doesn't tend to ask for the names because they're a little bit more vague, the names that are actually used for this side and here. These ones seem to have specific names that the examiner is prepared to hang their hat on. In the workplace, is anybody going to come along and go, oh, I think you'll find that was an error of principle, and the other person goes, oh no, it was an error of commission? No, nobody gets a monkeys. They're just errors, and we fix them. But so in the workplace, it's very much about setting up your systems so that you don't have errors. So the miscasting errors, brought forward balances, carry forward balances, the way that you add, the way that you reconcile to spot miscasting errors. Being aware that errors can occur, so checking for them, and then fixing them when you find them. So that's the more important thing in the workplace. But in the exam, 3 marks, or simple marks anyway, so we'll name some errors for them, which is fine. Okay, so let's go through these names of these errors and what they are. So here we have our errors that don't affect the trial balance. Error of omission and missing item. So the journal's missing. So an invoice is missing from the sales daybook, or the invoice is missing from the purchase daybook, or we haven't done the bank reconciliation, so the bank charges are missing. Error of omission, an item that's missing. An error of principle, so that one's an easy one. An error of principle one is the toughest one. I think that people sort of struggle to know what is an error of principle and what is an error of commission. So an error of principle is where the error sort of breaks with, the journal that's posted is no longer in accordance with generally agreed accounting principles. Either because it fundamentally breaks the accounting rules, so it breaks with assets equals liabilities plus capital classifications. So we post motor vehicle expenses, a capital account, into motor vehicle at cost, an asset account, and therefore that's broken with the fundamental account equation, assets equals liabilities plus capital. So it's broken with that there, and our assets are too high and our capital is too high. Fundamental error of principle. Fundamental break with accounting principles. There is another one with an error of principle, which is that we used a company's accounting policy. We broke a company's accounting policy. So we value, the company's policy is to value stock first in, first out. You'll do these at level 3. First in, first out, and you use last in, first out. You do those at level 3, so you won't see this at level 2. You won't see that sort of break with the company's accounting policies at level 2. You're only going to see ones at level 2, which are, I posted it to an account, and one of the accounts should have been, let's say, an asset, but I posted it to a liability or a capital account. That's how you know whether it's an error of principle. An error of commission is still that I posted it to the wrong account, but it wasn't an error of principle. So I posted it in the sales ledger to A Jones rather than B Jones. Did I break out of assets, liabilities, or capital classifications? No, I didn't. I was still in the same assets calculation account in there. Or I posted it to one expense account, motor vehicle expenses, rather than to office expenses. I'm still within the same capital classification of accounts. I haven't broken across those lines in there, so that's an error of commission. So it's an error, but an error of commission. An error of original entry is it's the wrong amount, but it still balances. So the journal still balances here. So here's I got an actual amount entered. Here, journal balances. It wasn't £110 invoice, it was £210 invoice. So that's what should have been posted. That would be an error of original entry. It's a balancing journal though. An error of reversal is the right amounts. So in error of original entry, because this balance sheet, this journal balances are trial balance balances. An error of reversal is the right amount, but it's the wrong way around. So here, instead of posting it to the debit sales ledger control account, I posted credit sales ledger control account. Instead of being credit sales, I posted debit sales and debit VAT. It tends to be in real life, people who have poor double entry bookkeeping because they learned dead click or whatever. Then they thought, oh well, sales are great, so things that are great are debit, therefore debit sales. Right, okay. No, not really. All it is assets equals liabilities plus capital. Sales is a liability to shareholders, and therefore is a money out item. Increase in money out item is a credit. So negative money essentially, and this is the positive money that we're coming in. Let's go sales ledger control account. So is the right amount, but they're the wrong way around. That's an error of reversal. Error of original entry, error of reversal. A compensating error is where there are two journals and the debits and credits in the journals do not add up. So the debits do not equal the credits in those journals. But there's two or more of them, and they perfectly offset each other, so the trial balance still balances. That's a compensating error. In real life, it tends to be an offsetting error, that it goes £1 million one way and £1 million the other way. It looks like your balance sheet's out by £1, so nobody's thinking there's a worry, but actually there's two massive errors within the trial balance. So all of these ones here do not affect the trial balance. Ones that do affect the trial balance are where the debits and the credits of the journal are not equal. So if we've got a question and it's saying which ones affect the trial balance and which ones don't affect the trial balance, you create the journal that is being posted, or even that is not been posted. So an error of omission has not been posted at all, so there's no difference in the debits and credits, so it doesn't affect the trial balance. Create the journal which has been posted, and now do the debits and credits still equal each other? If they do, then it doesn't affect the trial balance. If the journal has debits and credits that don't equal each other, then it will affect the trial balance. Now, the examiner calls it affect the trial balance and not affect the trial balance. I mean, the truth is it all affects the trial balance, but actually what it is that does the trial balance no longer tally, affect the trial balance, or does the trial balance still tally, the debits equal the credits? It doesn't affect the trial balance. It's poor wording, but that's what it means. So that's what we've got in terms of how we're going to do it, and the way in which you're going to do it is double entry bookkeeping exercise. You might need T accounts in terms of seeing what they do in total for the compensating errors in there, and you're going to use the money in money out method of journal production, positive money, negative money, and you've got some VAT calculations thrown in as well into those type of questions. So if you can create journals, you can answer this question, and that's how you're going to do it. So in terms of summary, then we've got these errors of principal, commission, compensating errors, reversal of entries, errors of omission, and errors of original entry. So those are the ones which don't affect the trial balance, and I've explained those already. Let's go through these other ones now. So these errors of transposition. So an errors of transposition is where I've transposed in from, let's say, a day book. So I've posted the figures in, but I didn't post, let's say, the VAT correctly from the sales day book. And as a consequence, the journal I actually posted didn't have the debits equaling the credits. So that would be an error of transposition. I've transposed the numbers incorrectly into the general ledger and into the subsidiary ledgers. A single-sided entry is I've missed either the debit side or the credit side. Different values of the debits and credits in the journal. Just I've got my debits don't equal my credits in the journal. I've got two entries on both sides. So I've posted them all as debits, or I've posted it all as credits, and my debits no longer equal my credits. Miscasting ones is like where, let's say I've got my T account and I've added up all the debits and the credits. I'm creating my carried forward balancing figure, and I get it wrong. And so I've got a wrong carried forward balancing figure, so I've got a wrong brought forward balancing figure. I've miscast the account. Now, or alternatively, I've added up my sales day book and I've added up the VAT column incorrectly. I've miscasted that. Because when I have a miscasting error in there and my either my brought forward balance from the trial balance is incorrect, or one of my columns in my day book is incorrect in there, effectively I've now posted a balance sheet, a journal that doesn't balance to the trial balance, and so I've got an error in my trial balance there. My trial balance doesn't equal each other. And then extracting errors are I've extracted the wrong figure from the general ledger T account. I extracted it as £210 rather than 120. So that's an extracting error. You don't tend to have to name these ones. Put them in there just in case the examiner decides to try and put that in there. Never seems to do that. There always seems to ask for the names on the trial from the ones that don't affect the trial balance. The one where he tends to sort of check this part by giving you a scenario, he or she tends to check that by giving you a scenario, and then you see whether your journal debits and credits balanced. So that's errors for this one. We've done name the errors, and does the error affect or not affect the trial balance? Does the errors create mean the trial balance no longer balances, or does the errors mean that the trial balance will still balance? In the next chapter, what we're going to do is we're going to be presented with some errors in the trial balance, and we're going to correct those errors using a suspense account. So we're going to have a trial balance that doesn't balance. So we're going to be having these ones here. Trial balance doesn't balance. We're going to put in something called a suspense account to make it balance. So let's say it was out by £1,000. We put the £1,000 in as a suspense figure, and then we're going to correct the journals and reverse out that suspense account by correcting out the journals. We're going to post it through those journals through a special daybook called the journal. A little bit confusing. Why is it called the journal? And the reason why it's called the journal is that it used to be controlled by the finance director or the financial controller, and it was for special journals that could manipulate the accounts so they wouldn't let anybody else have it. So it was called the journal. Get your hands off it, everybody else, and it was controlled by them. So it's a daybook called the journal. So all daybooks produce journals. Special journals go in the journal. Hopefully that was helpful. Thanks for listening. I'll see you on the next one. Bye bye.